Welcome to Money Talks. I'm Genevieve Westcott with your latest financial news from across New Zealand and around the world. In this edition, the New Zealand Institute of Economic Research slashes our growth forecast. Germany and France go on notice of a devastating credit downgrade just hours after they unveiled their latest rescue plan for Euro debt crisis. And New Zealand farmers head into Christmas enjoying a strong run. Dairy prices have stabilized, lamb prices will average around last year's level, and New Zealand beef prices have unseasonably lifted. Joining me now to tell us more about that golden spell is ASB rural economist James Shortall. James, welcome. Good to see you.
Good to be here.
So it's all good for the agricultural sector. Tell us more.
Well, yeah, I've been around the traps a little bit over the past couple of weeks. And most farmers are telling me, they've never seen it this good, which is interesting considering what's happening around the world and what's happening with a lot of the big economies, that agriculture here at home in New Zealand is going pretty well. And it's not only on the income levels, it's season, it's debt, they've got lower interest rates, so there's a lot of good things happening. And
they hit an all-time high in March. Tell me more, partly on the strength of the Kiwi dollar, of course.
Yeah, so we monitor at ASB, we monitor all the commodity products, the major export products out of New Zealand, and they really lifted strongly through the beginning of this year through to March. So we had very, very strong dairy prices, of course. We also have had strong land prices. Logs have also been, and the forestry sector have been very, very positive, and they lifted right through to sort of March. They've been tailing off a little bit recently, but they still remain pretty strong.
And strong incomes right across the rural sectors.
Yeah, it's a bit different this year to what we saw in 2008 when we did have another sort of agricultural commodity boom. I mean, the main factors there were around dairy, where we saw that big payout come out around $7.90. But the difference we're seeing right now in 2011 is that we're seeing it across the board. So we're seeing sheep, beef, deer prices, forestry, dairy, the whole lot are doing very, very well. And that's quite different to what we've seen in the past, much broader, and it's meaning pretty good things for agriculture.
Now, the Reserve Bank here at home has been talking about the level of agricultural debt compared to the income. What's the latest there, James?
Yeah, well, there's a couple of key things there because they were quite concerned going back a year or two about the debt levels, particularly in the dairy sector. So that, there's been a lot of talk about this, but the strong incomes and also low borrowing costs. So we're seeing strong incomes, good seasonal growth, and very low borrowing costs for a lot of people means that people have been really paying off debt, and that's meaning that the Reserve Bank in their latest financial stability report released in November, they actually said that they've seen quite a big change in the decreases in debt, and the revenues are really boosting it. So things are starting to come back into line. They're feeling a bit more comfortable, and credit growth is pretty much flat right now.
Okay, let's look at dairy right now. First of all, let's start with the global dairy trade auction overnight. What kind of results are we seeing?
It's going up, yeah. I mean, we've seen the second consecutive increase overnight, 2.6%. That's on top of the 2.6% we saw the last one.
What's going on?
Yeah, I mean, it's quite unusual because given what we're seeing around the world, and we've seen agricultural commodities in most markets out of the US, corn futures, that sort of thing have been declining. But dairy prices have actually lifted. So that really bodes well, in my opinion. It's really positive for the market, and it's fantastic news. So that coupled with the fact that we're seeing the New Zealand dollar drop and drop off those very, very high levels really means that we can be a lot more positive about the coming year and much more confident around the current payout forecast.
And yet demand is dropping off in some of the major markets as well, right?
Yeah, well, we've seen China, then their imports for some products have really halved over the month of October. So they were a big reason why we saw those increases in commodity prices through the early part of this year. Since that time, their imports have really fallen off. So demand has tapered off. We've also seen production out of some of the big countries has been going pretty strongly. Of course, the US has been running at about 1.5%. Lifts on production from the last year. Here at home, we've probably been running at 10% over last year level. So some pretty positive factors out there in the market.
Beef market remains unusually high. How long is it going to last?
Well, I don't think it's going to last too much longer. I am positive about where beef is going and where prices are going, and that's really around what's happening in the US market. They remain very, very short of beef. Their herd's down, and I think those positive factors are going to come through probably through the middle part of next year. But we have seen beef prices, beef schedules lift over the past couple of months, which is unseasonal, of course, through the spring period. I think they are going to tail off a little bit. We might see that through the early part of next year, but from then on, I'm positive about where prices are going and positive about the next 2 to 3 years.
And lamb prices as well continue to just rocket along.
They continue to rocket along, but I just get the feeling that it's only a matter of time before we start to see those prices fall off.
Why?
Well, we're starting to see, we've seen a lot of supply that hasn't come on board this season. We've seen the slaughter rates are around 500,000 less than what they have been the last year. We're also seeing an increase in supply across the whole year. There's going to be about 1.3 million more lambs this year than last year, according to the Beef and Lamb Economic Service. So, I think there's going to be more supply that's going to come on board. We're also getting pushback from our international markets. So, I'm picking that those prices are going to fall off these all-time highs that we're currently seeing, but realistically they're going to stay high, and they're going to stay around the last year level. So it's positive.
Thanks, James. Coming up after the break, shipping giant Maersk pulls the pin on the Port of Auckland over work stoppages affecting millions of dollars worth of vital exports. And the New Zealand government's operating deficit grows while the tax take is down. But first, you'll be pleased to know that New Zealand's brand as a country is stronger than Australia's, at least according to one international survey. So answer this in our Farmers' Facts and Figures quiz. Where does our country rank for brand power compared to the top 5 in the rest of the world? The answer when we return. Stay tuned. Welcome back to Money Talks. Just before the break, we asked you, where does our country rank for brand power compared to the top 5 in the rest of the world? According to the Future Brand Index, we rank 3rd. Canada was number 1, woohoo, followed by Switzerland. We were number 3, trailed by Japan, and right at the bottom in 5th spot, Australia. Go figure. Joining us now is our foreign exchange expert, Derek Rankin, director of Rankin Treasury Advisory, who keeps a close eye on the markets 24/7. And the markets liked hearing that Italy's new Prime Minister, Super Monti, has released his plans for a new austerity budget. Derek, great to have you on the show.
Thanks for having me.
Let's start with Italy. Super Monti now has new plans, a new austerity budget. Is he going to be able to get it through the rest of the politicians and bring it to the people?
Well, the politicians have been quite smart here. What they've done is they've put a technocrat in to run the country, deliver all the bad news, bring all the terrible news to the people, put it all through, and then get rid of him. And then the politicians will come in when things start to get better, and they'll claim that they've fixed it all. So really, where we are at the moment is he's actually managed to get the budget through the cabinet, and it's now being debated in the Houses of Parliament, and it's expected to pass sometime this month.
Is it going to be too late? This is the question now. Every week it seems as if we say all eyes are on Europe, and it continues to be so. But now we've had, of course, the credit agency downgrade by Standard & Poor's of 15 of the Eurozone countries, including Germany. Yeah, what does this tell you?
Well, what's been interesting is over the last week that interest rates have been coming down. The long-term bond rates for Italy particularly have come down nearly 1%. So the market is basically saying, we like your budget, we like what you're doing, we like the austerity program, keep going, carry on. And I think it will go through as a result. So I'm not as negative as a lot of people are on Italy. Italy's got a primary budget deficit around 4% of GDP, and it's starting to, they'll bring that into surplus, providing they actually bring the tax relief through, then they'll bring it into surplus in 2013.
Let me do a little quick diversion because talking about interest rates coming down, James, across Australia, they've slashed theirs again for the second time in 2 months. What's happening over there?
Well, I guess they're suffering like everyone else, and they're worried. There's every chance that we could see further decreases in their overnight cash rate, effectively, and could go on even further from there. So, they're concerned about what's happening out of Europe. They've seen a decrease out of China. Their own economy's sort of stumbling a little bit. Probably not going to go back to the scorched earth, or not scorched earth, but the tough times around 3% when they got down to in 2008. But they have certainly had to change tact a little bit, and it's quite interesting that Australia, which has been a bellwether over the past couple of years, and they are now starting to really feel the effects of what's happening around the world.
But, they're still way above what so many other countries in the world are sitting at when it comes to interest rates. Many of them 0% or not much above that. Let's go back to Europe, Derek. You said that over the past 7 days, there were 3 key events that shaped where the global markets will be heading now. Talk to me about that.
Well, the 3 key events that we actually saw was the EFSF being leveraged. That's the first thing. And this is the bailout fund. And so they're trying to get that money that is actually really promised money to be used as more like an insurance bond, to actually guarantee some of these bonds that these countries are issuing, which means they don't have to put 100% in. They're only talking about putting 30% in. And that means it's got greater firepower, but it's still nowhere near enough. And then we had the Italian budget. And then the third thing, of course, was the intervention by the central banks to increase the swap facilities and to lower the interest rates on those swap facilities. Effectively, that's the world giving the market more US dollars. And they can use those US dollars because they were suffering with US dollar withdrawals.
Now, behind the scenes, of course, we know that China, which is driving so much of the global economy, is really starting to slow down. The world is worried. What impact could that have on Europe, James, and on people like us?
Well, I think it'll have probably more potential impact on us than the Australians.
And certainly Australia with all the mining.
Yeah, definitely. I mean, let's be careful that they are slowing down. They might slow down to what they really want to be, sort of around that 7 and 8% mark, as opposed to the 10% or 12% that they've been going at over the past couple of years. So, yeah, that's a pretty significant slowdown, but not drastic. I guess the real risk is that if we start to see things really turn to custard in Europe, then the Chinese will pull back even further than what the expectations are now, and that would really have an impact on us. Our dairy consumption potentially, potential trade issues, cash flow issues, that sort of thing. So they're the real concerns, and if that was to happen, and to happen to China as well as other Asian nations, then that could be a bit of a real concern, I guess.
I don't know if I'd agree with you completely, James, because I think China does have a lot to do with Europe these days. And what's your take on it, Derek?
Well, I actually think that people forget that China wants to slow down, that they actually injected a huge amount of money into the economy in 2008, and that's created inflationary problems, and that's created overheating. And so they're actually engineering this slowdown. They raised interest rates significantly, and they tightened their capital adequacy requirements for their banks to 21.5%, which is the highest on record. So now they've got plenty of room. They're starting to ease that back. I don't think they'll cut interest rates, but I think they'll continue to ease back on that provisioning of capital that banks need to do. And the slowdown that they're actually seeing, as James said, they'll be ticking along at 9%. Countries around the world are going to be killing for that sort of level. Yes. I agree with you that Europe is a problem for them. But Germany and France, which are 70-odd% of the Eurozone, are not actually in a mess. It's not a crisis for them. And I'd make the point too that if you look at it, quite often you hear about it being a Euro crisis. It's not, it's a European crisis. The Euro is at exactly the same level, at 134 right now, where it was at the beginning of the year.
So you don't think there's any danger of it dissolving anytime soon?
I don't think they'll let the Euro dissolve, no.
Why not?
I think the political capital behind it, there's too many reputations at stake here. They will defend it to the death.
Do you think that the S&P downgrade was merited? Or is this kind of a PR stunt to make it look like the credit agencies around the world, the big three, are really watching what's going on?
I think the credit rating agencies have lost a huge amount of credibility over the years. They didn't pick the 2008 GFC, the financial crisis, and now to be downgrading in a massive move, 15 countries. I think that the rating agencies coming out at this time, when they're right in the middle of these delicate negotiations, right before a European summit, you got to wonder, whether there's actually skullduggery here. And this morning they've come out and said that they're going to they put on negative credit watch the European Financial Bailout Fund.
It was interesting this morning. I don't know if you saw Angela Merkel on TV, but someone asked her a question about the downgrades, and she just sort of dismissed them completely and, sort of didn't really give them a whole lot of credibility. And it was interesting to see her. I mean, she's obviously, I don't think she's willing to have her hand forced in terms of what these credit rating agencies are saying. I mean, in some ways that they have so much power that they're saying, okay, if you don't do X, Y, and Z, then we're going to downgrade you. And, we're talking about superpowers here in terms of sovereigns and that sort of thing. They know the market. They know what they need to do. If they execute on their plans, then things should come right, as opposed to executing on what S&P think they should do.
Well, here at home, we're going to see some power wielded tomorrow with the Reserve Bank of New Zealand. What's the call going to be on the official cash rate?
Oh, no change. I mean, I don't think there's too many arguments about the fact that we're not going to see any change.
But when are we going to see change? Has that changed for you?
We're picking that. It has already changed. We've sort of been picking that it could see an increase through the middle of next year. That's going to be pushed out through till the late next year. And in my opinion, then that sort of starting point is getting pushed further and further out because of what's happening in Europe. The market's actually picking that we could see a decrease, but I don't think that's going to happen.
Derek, what do you reckon?
Oh, I agree. I don't think there's going to be any change. But I think Christchurch is fascinating to watch. And one of the stats that I got out, which I found particularly compelling, is that 1,100 commercial buildings have been destroyed. When the program of rebuilding is underway, they will need to build a new commercial building and complete it every 3 days for the next 10 years. It's a massive job, and the construction down there is going to be enormous. So when that starts, the Reserve Bank will be raising rates. And so really what you're asking is, when is Christchurch going to start? And we don't know that until the shakes really calm down and we get a period of calm.
Not only when is Christchurch going to start rebuilding, when is the new, old, whatever you want to call it, government going to start making some tough decision and driving growth? How do you think John Key's going to go? I think people over the next 3 years are really expecting to see Action Man now, not John Key, nice guy. What do you reckon?
Well, I think that the specials, they're waiting to see what the specials do in terms of where the Maori vote comes out and in terms of how much leverage the Maori Party actually has on the ultimate makeup of the government. There's a chance yet that National could lose another seat and that may go to the Greens. And so the numbers might be finer yet than we think. We get those numbers out this weekend. So
yeah,
we'll
but listen, meantime, we find out, shock, horror, probe, that the forecast for how the budget was doing that came out just before the election, guess what? They got it wrong. James.
Yeah, I mean, the situation's worse and worse, and that's probably a common theme that we're seeing around the world, that there's the things aren't as good as what we previously thought. Christchurch is going to cost more. The economy's not doing quite as well. The tax is not as sharp as what it has been. So, we are dealing with some slightly different dynamics, I suppose, coming over the next couple of years, and you'd have to say that there's more risk that it's going to get worse than it is that it's going to get better in the short term.
I think you've got to be a bit careful here, because in New Zealand particularly, we had the World Cup and we had the election. Lots of things slowed down. People stopped making decisions and people were spending money on World Cup tickets. So you talk to businessmen out there and they found it particularly flat in that period. And so I think we've got to be a bit careful that it wasn't influenced by that. Also, I think the European crisis has really blown up confidence, and that meant that a lot of people went back into their caves.
The New Zealand Institute of Economic Research has now slashed again the growth forecast coming up. Are people who do this kind of forecasting, are they afraid to tell us the truth? I mean, it's never good news, and it's always worse than we expected.
I think if you actually look at the numbers, you'll find that in many cases the actual data is better than we expected. It's the sentiment that is so bad. People expect it to be bad, and it isn't. I looked at the BNZ had a graph that they do. Every time a positive piece of data comes out, they give it a 1, and every time a negative piece of data comes out, they give it a -1. And the graph is going through the roof on the United States economy. The data is always surprisingly better than we expect because we're so gloomy.
Thanks, Derek. Coming up after the break, Future Proof on the highways and byways of the economic world. Get on board as our experts take us along for the ride and point out what they'll be watching over the coming week. But first, it seems Kiwi firms are more upbeat than our Aussie counterparts. Derek couldn't agree more. And to prove it, they're looking to increase their borrowings to finance growth strategies. So answer this in our Farmers Facts and Figures quiz. What percentage of small and medium-sized New Zealand firms think business and the economy will grow in the year ahead compared to Aussie firms? The answer when we return. Welcome back to Money Talks. Just before the break, we asked you what percentage of small and medium-sized New Zealand firms think business and the economy will grow in the year ahead compared to Australian firms. 68% of Kiwi firms are picking more growth next year compared to just 57% of Australian firms. Now, Derek, talking about Australia and how confident they are, you've come up with some interesting statistics. Tell me more.
Well, I was looking at the retail rates in Australia, and like retail mortgage rates in Australia are actually below ours. And I find that really interesting because their cash rate, they've just lowered their cash rate, but their cash rate is still something like 2% higher than ours, and yet their retail mortgage rates are actually lower than ours. So I thought that was really intriguing, and I guess the only explanation for that is that the cost of borrowing for New Zealand banks is a lot higher than Australian banks. And then I started to think, well, hey, they're all the same.
That doesn't make sense.
So,
James, what's your take on it?
Yeah, no, definitely the cost of borrowing I think is higher, and there's every chance that could increase further. I mean, in terms of what's been happening over the past 3 years, we saw these funding premiums come out of nowhere because of the global financial crisis, and they haven't really gone away over the past couple of years, even though conditions have improved through that period of time. But there's every chance that premiums could lift a little bit higher. The Reserve Bank signalled that. They've also, their latest financial stability report, they pulled back some of the additional measures they were going to put in place because they are worried about the global situation, meaning that funding costs for New Zealand banks will lift. So, I think that the point Derek's making is that the official cash rate is a little bit irrelevant in some cases to what mortgage rates and interest rates in general are doing, and we are getting influenced by other factors too.
Okay. I'm interested now, gentlemen, in both of your takes on what's happening at the ports of Auckland. We now know that Maersk, the biggest container shipping company in the world, has pulled out. They're tired of the job action, collective agreement difficulties between the union and the company, Ports of Auckland, and they're moving everything to Tauranga. 327 guys on the job. This is what it's come down to. It's going to cost the Port of Auckland $20 million a year. Is it worth it?
We're the last stop on a bus route at the end of the day, and the shipping lines hold an enormous amount of power. So for years and years and years, I've watched as they've manipulated one port against the other port, saying, well, we're not going to call in at you, and unless you do this, unless you do that. So I would say that at this stage, it's probably more negotiating tactics for other deals down the track. They're trying to get some benefit for the company in the long run, and it's fair enough that that's what they have to do. But Ports of Auckland really has to sit down and I guess the union people really have to think about it a lot harder.
Yeah, I mean, we've had strikes and we've had lockouts, so both sides in the dispute seem prepared to take the risk. I wonder if that makes sense in 2011 with the way the world is moving.
Well, you look at some of the other things happening around the world, you look at Qantas, some of those issues, then I don't know, it's just not quite, timing doesn't feel quite right. I guess there's a bit more negotiating power and a bit of power around some of those things, but ideal timing, probably not now.
I know a lot of people who work for a lot of companies that haven't had pay rises in years. Are union boys and girls today, whether it's teachers or whether it's wharfies, are they living in an unrealistic?
There's not a lot of public sympathy for their cause at the moment. And if you look around the world, in the UK, they've got a lot of strikes going on, and the public are just saying, look, we're in a mess, we need to sort this out, and you guys aren't helping. So politicians are actually a lot more brave, if you like, because they know they've got public backing, and they're prepared to take them on.
What are you going to be watching, James, over the next 7 days?
I think the currency movements have been quite interesting, and I'd be keen to hear Derek's thoughts on what's happening with the currency, because we've seen a big pullback, and it's very important, of course, for agriculture, for farmers in New Zealand. Hear his views. I mean, our views are that we're going to see the currency could be a little bit lower than previously expected, probably hover around those mid-70 mark, maybe up to these current levels we're at right now. So that's a big change. That's a 15 to 20% change from the peak that we saw, and that's going to make a big improvement to cash flows for farmers.
What do you reckon, Derek? You are the expert.
Thanks for that.
Yeah, that's scary, isn't it?
Yeah, well, if I'm the expert, then gee, you've got problems. No, all I think about is that the New Zealand dollar is really interesting. The New Zealand dollar opened the year at the same level that it is right now, at 78 cents on January 1. The euro opened the year at 134, so exactly the same level. If you look at all the major currencies, they're at exactly the same level right now that they opened at the beginning of the year. Now, we've had huge volatility in the meantime, but it's really interesting that they're back at the beginning of the year levels. And I would argue that the European situation has got a lot worse over the year, and yet the euro hasn't got a lot worse over the year. So therefore the euro is really not a very good measure of this crisis at all. In fact, the euro could actually strengthen. So I actually think that the New Zealand dollar's got room to go higher. I agree with James, it still looks a bit soft, but you know, we've had an Australian interest rate cut yesterday, and then we had the Fonterra news this morning. I think the New Zealand dollar is actually going to push back over 80 a year out, probably towards the end of next year. We're looking to have a 9 on the front of it.
Okay, we'll have you back in the new season and we'll see how you're tracking. Thanks to my guest, Derek Rankin, Director of Rankin Treasury Advisory, and ASB Rural Economist James Shortall. Be sure to check out our website for all kinds of great programming. Meantime, the next time someone asks you to pop into the dairy to pick up a loaf of bread, you might want to consider this approach. Just think what you'd save on petrol. Warning, don't try this barefoot.
A lot of people think I'm nuts.
Keep the faith. See you next time.